IVM.
BQ Big Decisions, the BloombergQuint podcast that helps you make the right financial choices. For many of us, there is one purchase that we long to make. It will likely be the most amount of money that we spend on anything in our lives. The decision to make this purchase is fraught with emotion, and everybody, from family, friends and colleagues, seems to have an opinion about it. I'm talking about buying a house. In one of the first conversations that we had on this series, that's BQ Big Decisions, we debated whether or not it makes sense to buy a house or if it's better to just live on rent. The high cost of real estate, especially in metro cities of Mumbai and Delhi, have made buying a house a difficult proposition for most individuals. In most instances, a loan is unavoidable. We're going to talk today about the taking of a home loan, the impact it has on our finances, the tips and tricks to get the best possible rate, the change in the regulations governing the prices of loans, and whether it makes sense to shift your MCLR loan to a repo-linked loan. If that last bit doesn't make sense as of now, don't worry, it will soon. You're listening to BQ Big Decisions on BloombergQuint, and I'm Alex Matthew. My guest today is Suresh Sadgopan, the founder of Ladder7. Thank you so much, Suresh, for joining me today.
Yeah, my pleasure. Thanks.
Now, let's start with the taking of a home loan. It's, like I said, it's a decision that's fraught with a lot of emotion. It's also something I fear that a lot of people, when they decide to do it, they do so without accurately estimating the kind of impact it has on their finances.
Yeah, absolutely. You bet. I mean, a lot of people, like you rightly pointed out, a lot of people actually want that home.
Yes.
The only thing is, I mean, and again, like you rightly pointed out, I mean, in Delhi, Mumbai, and for that matter, in many other cities today,
yes,
it's extremely difficult to buy a house. I mean, we are all talking about north of 1 crore today.
Yeah.
And in maybe class 2, class 3 cities, it probably is going to be maybe 60, 70 lakhs.
Yes.
So, which is also not a small number to talk with. So, I mean, they'll have to put a certain amount of money from their own sources. I mean, now most of the institutions expect you to put in 20-25%.
Yeah.
And balance can be sourced as a loan.
Yeah.
So, still we are talking about big numbers.
Yes.
Yeah, I mean, a lot of people are they really desperately want a house. But they're not very sure, I mean, where the money will come from. They broadly estimate, yeah, okay, fine, this is where it will come from. But the thing that they fail to estimate is that home is not the only goal.
Yeah.
Home is one of the important goals.
Yes.
There are various other things. Like, I mean, take the simple case of a vacation. Even that has to be factored in.
Yeah.
I mean, just because you have bought a house, you're not going to stop living, right?
So how do you go about it? So, and it's interesting that you say that 1 crore is now commonplace. I think about 20 years back, people would do a double take and say, whoa, that's a lot of money to pay for a house, right? So now it's commonplace. And the other thing that's happening, I think we spoke about it in either an earlier episode or in fact on BQ Portfolio, the Tokyoization, if you can call it that, of houses in Mumbai, where you're buying smaller houses for more amounts of money. So, but that's a different conversation. If we're talking about going and doing this, making this decision, buying a house, what are the various factors that you think you should bear in mind when you're doing it?
See, this is a very, very important decision and a very big decision that somebody is taking. So you are going to live in that house for a long period of time.
Yes.
So let that house better be a good house that you are getting into. See, I'll tell you typically what happens with most people. They do want to have a house, and I understand that sentiment.
Yes.
And we all have that sentiment. I understand that sentiment. Yeah. But the point is, most of the people get into a house which they can afford, not necessarily the house which is ideal for them. So let me give an example. Suppose there are, let us say, 5 people in the family, and all they can afford is just a 1 BHK. It may not be the ideal house, but that is what they can afford.
Yeah.
And they want the security of their own home, and they get into the 1 BHK home. I mean, thinking that they'll be very happy with that. For most part, they may be happy also in their own home. but that is not the ideal one from their point of view. So that's a challenge which a lot of people do face.
And when we're talking about the financial aspects of it, when they're looking at, say, the income that they have every month, I've heard it said by a few people that you should bear in mind, obviously we're assuming here that people have to take a loan, which is the case in most situations.
Yeah, it's almost, you can say, unavoidable to take a loan as far as homes are concerned. I mean, when we are talking about, say, 50 lakh, 60 lakh or 70 lakh to be borrowed, considering the home loan prices, I mean, you are going to take maybe 50 lakhs and upwards in most cases.
So when you do that, is there a benchmark that you can have when you're talking about the affordability, the amount of money that you're going to be spending as an EMI every month?
Yeah, there is no specific, specific number that I can give. But at the same time, what we will have to estimate is, I mean, first of all, you have an income.
Yes.
And there are certain expenses which you will have to exclude from that. I mean, the typical monthly expenses and the typical annual expenses which you will have to anyway spend. So those will have to be taken out.
And those are not just your current expenses. Those are also your expectations of future expenses.
Correct. So, and there may be certain patterns even today which you will have to account for.
Yeah.
Like, you have a child education expense which is there. It is not part of probably the monthly expenses, but you will have to pay maybe twice a year, for example.
Or it's something that could come up 4 years from now, which...
Yeah, so those are the goals. Yeah. So one is the regular pattern of expenses I'm talking about. Apart from monthly expenses, you have vacation, you have various other household goods which you buy and
or
stuff.
Retirement.
So, and what you are talking about retirement is a very, very long-term goal.
Yeah.
Of course, we need to keep that in mind. So what I would say is when somebody is actually buying a home, when you factor, when you take out all these expenses, monthly and annual expenses, and whatever amount you have, you can go, I mean, after taking the expenses, I'm saying, I'm not talking from the income point of view. Income minus all those expenses. So maybe 70-80% of the rest can go in terms of any kind of loans.
Okay.
And balance 20%, I would say, should still go for the long-term goals.
Okay. That's interesting.
So the reason why I'm saying this 70-80% is that the interesting part is the EMI is going to be a constant number.
Yeah.
And hopefully your salary or income is going to grow. And that gap is going to widen. I mean, the amount of surplus that you will have over a period of time, it normally happens in most cases. So over a period of time, the EMI is not going to affect you that much. Probably in the first 3-4 years, it may affect you a bit. But over a period of time, that number will not really bother you much.
And then you can also look at prepaying. Do you generally advise your clients to prepay wherever possible?
I mean, I have a nuanced answer on that.
Okay.
In the sense that, I mean, it's not advisable in all cases. Suppose somebody has taken a huge amount of home loan. And really, it is not a comfortable amount to take in the first place. So for those kind of people, we would want them to prepay as and when it is feasible.
Okay.
Like when they get a bonus or when they get an incentive or ex gratia or any amount like that.
Yeah.
We ask them to prepay.
Okay.
And when it comes to a certain level where they can get advantage of the interest amount which is going out. Like for example, suppose it comes to say maybe 25 lakhs or thereabouts. We generally advise people to keep that amount of home loan intact. Because if you are going to pay, say, 8.5 is the home loan rate or 8.75 is the home loan rate, and you are also getting a 2 lakh benefit in terms of deduction.
In case you didn't know this, by the way, you do get as of now, you get a 2 lakh rupee benefit for each working member of the family, right? For the interest paid on a home loan, that is the amount that you can deduct in a year from your taxable income. So assume that your taxable income is 10 lakh rupees and you're paying 2 lakh rupees, which is maybe not the math. It's just off the top of my head. It may not actually add up to that. You can deduct up to 2 lakh rupees from that 10 lakh rupees for interest payments on your home loan.
Correct. So, when it comes to a certain level, like say 25 lakhs or thereabouts, it may make sense for you. The interest payment will be roughly in the ballpark of 2 lakhs.
Okay.
So we allow, we generally ask people to keep it around that level if it does not really hurt them.
Okay.
So that is what we normally do.
Okay, it's fair enough. So if it's significantly above that, you say prepaid. Okay. So I think that more or less covers the aspect of the taking of the loan. But there is a bit of a conversation to be had about the pricing of the loan, isn't it, Suresh? As of 1st of October this year, there was a change in the way in which banks have to calculate the rate that they charge to customers. It is now linked to an external benchmark. Let's talk about that.
Correct. So it can be linked to an external benchmark, and repo rate seems to be the one that most banks have cotton on to. From 1st of October, repo rate linked home loans and other loans will be available from the banks.
Yeah.
The good point as far as the external benchmark, like a repo rate, is that it is something we all know.
Yes.
And it will be linked to that, and the transmission of the rate will be virtually immediate. So once in 3 months, they do set that to that rate. So from that point of view, in the previous regime, MCLR regime, there was an accusation that the banks were tardy when the loan rates did come down.
Especially on the downside, when the interest rates are coming down.
Purely on the downside. On the upside, they did it with alacrity.
Yes.
But on the downside, they were very tardy. So, and that is something, it is not just an acquisition, it was actually a reality. So, and RBI is completely aware of that, and that is why they have come with
repo-linked loan. In case you didn't know about this, dear listener, and I'm sure that a lot of you already do, the repo rate is what the RBI charges for banks to borrow from the RBI. It's a very short-term rate loan, and it essentially governs all of the rates in the money markets, particularly on the shorter end of the tenure. In fact, one of the conversations, Suresh, that we've been having this week is that the longer term, the government bonds, the transmission hasn't happened, but there are various factors for that to happen.
Correct.
And the other accusation is the fact that credit transmission, that is the rates that banks charge, that hasn't happened. So we're hoping that this new regime will help it take place.
Correct. So RBI, has always been worried that the transmission is not happening.
Yeah.
And over a period of time, they have been working on seeing how the transmission can happen. One of the things they have been doing is they have been calling and talking to the bank chiefs.
Yeah.
But that does not seem to have worked too much. And that is precisely one of the reasons why they have come up with a repo rate linked loan or any other external benchmark linked loan.
So the theory is that every quarter, if there is a revision during the quarter of, say, 10 basis points in October, 10 basis points in November, then as of the 1st of January 2020, there should be a 20 basis point reduction in a home loan.
Now that will be a reality. Once upon a time, you have to speculate whether that will happen or not. But now I think that's going to be a reality. And that is the positive as far as borrowers are concerned.
Okay.
Today.
So now all new loans that are given from the 1st of October onwards are linked to an external benchmark. That is mandatory.
Correct.
But having said that, there are several loans that existed before the 1st of October, and those all were governed by the MCLR. Now, the marginal cost of funds lending rate, let's talk a little bit very quickly about how that used to work. It's basically the average of several costs that the bank has to pay, and that coming down or going up would effectively change the borrowing rate for new borrowers, and eventually, and this was the biggest criticism, it would eventually trickle down to the existing borrowers, right?
Correct. So the previous regime, the MCLR regime, was left to the banks to decide what is their cost. If the bank were efficient and they say our cost is, let us say, 2.5.
Yeah.
So that particular bank's borrowers will benefit from it. But it was left to the bank to decide what is their cost. So, and that was the real problem.
Okay.
So suppose there is an inefficient bank and their cost is, let us say, 2.8. So, they are not really, there is no incentive for them to become better.
Yes.
So they just say that our cost is 2.8 and they charge that and put it on the customer.
But that isn't the case for the repo link loan.
Yeah, because this is an external benchmark and it doesn't have any bearing whether you are efficient or otherwise or what your costs are.
There's a fixed component to it.
Yeah. So what happens in the repo linked loan is that there is a repo rate. Let us say the rate is 5.05. And on top of that, you can charge something like 2.25%. Okay. So that will basically cover all the other operating costs that the bank may have. And on top of that, based on the credit quality of the borrower they are dealing with, there can be another 0.2, 0.5, 1%, whatever. Depending on that, they can charge for based on the credit quality of that borrower.
Okay.
So that is how the loan will be priced.
So that's an interesting conversation to have, right, Suresh? It's that and I was looking at the State Bank of India's website, and I was looking at the loans that they have on offer. The floating rate home loans, as of now, for loans up to 30 lakh rupees, interest rates start at 8.2%. For those between 30 and 75 lakh rupees, the rate starts at 8.45%, and for loans above 75 lakh rupees, the rate is 8.55% and above. But that's not to say that everybody who goes to the bank will either get that quantum of home loan as well as that rate, right? So that
Absolutely. So, I mean, all the borrowers are not the same, right?
Yeah.
I mean, the credit quality is going to be different. As much as there are AAA rated companies and AA plus companies and so on and so forth. Even in the case of borrowers, there are borrowers who have a very high credit rating, and today we have the CIBIL scores or any other external scores to validate that.
Yes.
So the banks will have access to that, and they will validate that, and based on that, they are going to price the loan.
But it's more transparent than the earlier regime.
It is transparent in the sense that, I mean, the rate is pretty much known to everybody. So if I'm applying for a loan, or anybody is applying for a loan, they will obviously source the credit score. And then based on the credit score, they'll price the loan.
Okay. So now this is where you can actually look for the best rate possible, because you have the fixed benchmark, you have the spread above that for operating costs, etc., and then the amount that is charged based on your credit score. You can go from bank to bank and find out what they're charging you based on your credit score, right?
Yeah. Yeah, you are right. But the only thing is, if your credit score is bad, I mean, the loan rate is going to be high. So it may vary by maybe 0.1, 0.15%, but you can't do anything. I mean, if the credit score is low. So one of the important things, as far as you listeners are concerned, is that it's very, very important for you to have a good credit profile. So if this also takes us to the beginning of the conversation. You have to be very cognizant of the fact that when you take a loan, you should be in a position to service the loan properly.
Yes.
And if you please take a loan only if you are in a position to service the loan properly. I mean, think twice, thrice before taking any kind of a loan, including a home loan.
Yeah, because any mistakes that you make in the repayment of that could have bearings not just on the immediate future, but any time that you look to make further borrowings.
Absolutely.
In the future.
Making good the credit score, it takes time.
Yeah.
So you have to be very careful.
It can
about
go
that.
bad very quickly.
Yeah.
It
absolutely.
can go bad very quickly.
Yes.
Now, having said that, I want to talk a little bit more about existing borrowers. So these are borrowers who took loans before the 1st of October. Obviously, they took loans based on the MCLR regime that we spoke about. Does it make sense for them to change to the now perhaps more efficient repo-linked loan?
Yeah, I think broadly it would make sense for somebody to change from MCLR regime to the repo-linked regime. So I'm not saying this just because the interest rate in the system is coming down. So what is coming down today can also start going up at some future point in time.
Yeah, and one would assume that with the repo, of course, we talked about this. The banks were actually quite sharp in increasing the rates when the rates were going up. But having said that, people have to understand that if the rates go up, then their rates will go up as well.
Absolutely. I mean, we are talking about a home loan. The home loan tenure can be, say, 20 years, 25 years, 30 years.
Yes.
So we are really talking about a long-term loan. So we really cannot look at what is happening today or maybe in the next 2-3 years, where probably the interest rates may come down. At some point in time, it may start going up also. So the repo-linked loan can work both ways.
Yes.
So we have to understand that, and it's a floating rate loan we are talking about. So it's going to go both ways.
Yes.
But the primary problem with the MCLR is getting addressed in the repo rate linked loan.
Which is when the interest rates are going down, the transmission should be faster.
Yeah, the transmission will be faster in the case of a external benchmark linked loan as compared to the MCLR regime. So now coming to the point whether somebody who has taken a loan, MCLR loan, whether they should move to the repo linked loan. I would broadly say probably they should consider doing that, especially if they have a lot of residual period left.
Okay. So if they're in the first 5 years or 7 years of a 20-year loan,
correct,
then it would make sense.
Exactly. So if they are in the initial, maybe the first quartile of that loan payment, so then probably they should consider that. Because over a period of time, because the loan rates will move in tandem with the actual rates prevailing in the market. So this is actually better.
But having said that, there is a cost associated, because I remember when the shift happened from base rate to MCLR also, there was a cost associated for existing borrowers to shift to the new regime. It's generally a percentage of the loan that is outstanding, right?
Yeah, true. So, I mean, there will be a cost associated. You are absolutely right there. Normally it's a percentage. Normally it's something like 0.25% or thereabouts. What we will have to really look at is, like I said before, I'll reiterate that. I mean, if there is a huge residual period, let us say 15 years, 18 years, 20 years kind of residual period, it will probably make a lot of sense for you to shift that by paying that one-time cost.
Yeah.
But if the residual period is, say, maybe 1.5 years, 2 years, and you have, or maybe even 3-4 years, and you have an intention to prepay that at an aggressive pace, probably you may not have to do that. And
the reason for this, and I think I cannot stress this enough, is that over a 20-year period, you're likely to see several monetary policy cycles, right? Absolutely. So every time there is a declining monetary policy cycle, you shouldn't be in a situation where the interest rates are not falling, and therefore you're not able to get the benefit of those falling rates.
Correct.
Now, having said that, Suresh, there's also the possibility of moving to another bank and taking the benefit of the new regime, right? You can be an existing customer of, say, an SBI, and you can move to a Punjab National Bank or another bank if the rate offered is significantly lower.
Yeah, absolutely. I mean, you always have the option of considering the same bank, considering staying with the same bank, or if the current bank is not offering you a good rate, you can always look at external banks. See, the only thing which you will have to bear in mind is as far as the existing bank is concerned, they have all your papers with them.
Yes.
So you just have to, So I mean, there is no processing charge again. So if you go to an external bank, there will be a processing fee also.
Unless they waive it.
So of course, that is at their own discretion.
Yeah.
So they may waive it. Some of the people do waive it. So it's going to be a subjective decision. I would suggest that one should look at the existing institution itself, because most of them want to retain their customers.
Yes.
I mean, customer acquisition cost is high for any institution.
Yeah.
So they would want to retain that. And if one were to go and talk to them, I think you can actually hammer out a good rate for yourself.
Especially if you know what their competitors are offering. So you can say that, hey...
Yeah, of course, you'll have to do your homework. Yeah. And with all the facts and figures, if you go and confront them, I think you're going to get a good rate.
Yeah,
but staying with the same institution makes sense. But Alex, I get your point.
Yeah.
That if you do not get a good rate, you always have the choice of scouting around and going to any institution of your choice.
In fact, it makes a lot of sense to do that, because even a small difference in the cost that you get will have a major bearing on the interest payment that you make over a period of 15, 17 years.
Absolutely. So, I mean, so that is something that we have to bear in mind. So we cannot look at the initial costs alone. So, and that is also the reason why shifting from a MCLR to a repo rate linked loan actually makes sense if the period were long and if the borrowing amount is very high.
All right. So I think that more or less covers the conversation that we have on home loans. I'd like to invite my listeners to let me know what they think about the home loan regime, the new home loan regime, and in fact about taking a loan in the first place. Do write to us on any one of our social media platforms. I'd like to thank you, Suresh, for joining me on this conversation. It's been an absolute pleasure.
Thanks, Alex. Thanks for inviting me here, and thanks, listeners, for listening in.
Dear listener, that's all we have for you in this BQ Big Decisions podcast. But as you know, there's a lot more that will come up in this space. So do watch it for more. This is BloombergQuint.
If you enjoyed Big Decisions, check out some other podcasts on the IVM Podcast Network. You can check out Paisa Vaisa, hosted by Anupam Gupta, Advertising is Dead, hosted by Varun Dugirala, the Ronnie Screwwala podcast, hosted by Ronnie Screwwala, or Cyrus Says, hosted by Cyrus Procha. These shows are available on the IVM Podcast website, app, or wherever you get your podcasts from.
Janice, what do you think couples did before TV was invented?
I don't know, go for walks on the beach, long drives, fancy dinners, have more sex maybe?
But what did we do when we decided to move in together? We debated between the Chromecast and the Fire Stick.
We gave up on sleeping early so we could stay up watching true crime shows.
We got ourselves 3 cat babies.
And basically became the cutest couch potatoes around.
Okay then.
In case you guys still haven't got it, we are a TV crazy, Netflix loving, binge watching Mr. and Mrs.
I'm Anirudh Kuha.
I'm Janice Sequeira.
And if like us, you snort TV for breakfast, lunch and dinner, this is the podcast for you.
Tune in every Thursday on the IVM podcast app or wherever it is that you get your podcast from. This is
Mr.
and Mrs.
Binge Watch.
Are you constantly seeking happiness? Wondering how to make the most of every day? How not to let your inhibitions stop you from achieving your goals? It's now time to get your A game on. It's time to unlock your true potential. Tune in to the Empowering series with me, Zarina Poonawalla, to feel empowered in all genres of life. From behavioral skills to management skills. From health to relationships. From mental well-being to emotional well-being. And of course, your finances. I've got you covered. With these tips and tricks from me, Zarina, and true life stories from my amazing guests, you're bound to bring your purest to the table. Tune in to the Empowering series with Zarina Poonawalla every Thursday on the IVM podcast app, website, or wherever you listen to podcasts.